bear market, and maybe close to the end when everything starts acting alike. And we're seeing the capitulation of one market after the other. The Fed's getting a message, like it did in 2018. Watch out. I'd like to compare what we've been through the last year or so to what we went through right before COVID. So from February 20th to March 20th, our portfolios, our strategies, the performance, they were cut in half nearly. And it was in 1 month span as we thought the world was going to shut down, and we wondered about a depression and a collapse in many other ways. And at that time, we began to analyze the economy, or scrutinize every economic indicator that came out for clues as to what really was going to happen. How successful would the stimulus policies be? And as you know, we started this webinar series or YouTube series. At that time, every week we were trying to reassure people that, especially investors, that the world was not ending, that it did seem as though the global stimulus measures were going to work. And we also at that time started our mantra, innovation solves problems. The coronavirus crisis created a lot of problems, and innovation, whether it was in the genomic space, testing, vaccines, or in the work space, the hybrid, actually the remote work and now hybrid work. These were solving the problems of that day, and they're continuing. These are trends that have been unleashed and are unstoppable now. Now we are a year into a similar time period. The performance of innovation-based portfolios has been crucified, even though the number of problems that have cropped up in the last year have given innovation even more opportunity to perform. Now, because we did so well coming out of COVID, again, our companies were really helping to solve problems. We have faced in the last year the so-called comparison issue. Now, we have a 5-year investment time horizon, so we're not looking at year-to-year comparisons. Nonetheless, the markets got caught up in, oh dear, how much slower is it going to get? And so we've been grappling with the consensus Wall Street expectations year over year, and their worries that growth rates would continue to slow down into negative territory, much like they did during or in the aftermath of the tech and telecom bubble. We couldn't be further away from the tech and telecom bubble. The innovation that was accelerated during COVID is continuing apace. We see, because of Russia's invasion of Ukraine, food prices soaring, energy prices soaring. Well, electric vehicles are, we believe, starting to take the edge off of that. There's been an accelerated shift in consumer preferences towards electric vehicles. And so that, we believe, longer term will pull energy prices back down. I know I've been on record saying that energy prices are going to plummet back down to where they were in the 70s, we believe, longer term, because the move towards electric mobility is unstoppable, and it is now happening at an accelerated rate. The risk-off period that higher interest rates and inflation have caused has forced investors who have been risk-off, don't have as much tolerance for risk as they once did, to diversify back to their benchmarks. That they have done, we believe, and in so doing, they have sold our stocks. Our stocks are not in benchmarks, with the exception of Tesla in any great measure. And as you'll notice, Tesla has held up much better than other of our innovation stocks. It's because it was put into the S&P 500 and other indices in recent years. Actually, S&P was in late 2020, and since then it has held up better. So we believe that technology holdings are the technology and innovation holdings that will serve the future. future. And in contrast, the S&P 500's exposure to technology is 28% of that index. We don't own any of those stocks. We do not think that technology stocks in the S&P 500 are going to participate in the true transformation of the global economy in the next 5 to 10 years. Many companies, including those with fine earnings, are investing aggressively now to make sure they capitalize on some of the biggest opportunities of our investment lifetimes. Now, I've been around in the business for 45 years, and I've never seen the opportunities I see now. According to our expectations, truly disruptive innovation, which right now is valued in the global public equity markets at roughly $10 trillion, roughly 10% of the global equity market cap. We believe that 10 trillion is going to scale to 210 trillion by the year 2030. Monetary policy. The Fed raised interest rates 50 basis points this week. And I had been saying that I thought that would be a mistake. The markets are corroborating that it seems that the Fed is making a mistake. So we've seen the stock market go through a spasm. The S&P now from its peak is down 15%. The NASDAQ from its peak is down 25%. Pure play innovation strategies like ours are down 60 to 75%. So that's not just a spasm, that's a convulsion. And you'd think that innovation companies that are not in benchmarks are witnessing the end of their world. It couldn't be further from the truth. This is a huge inefficiency in the market, this tendency to move towards benchmarks in risk-off environments. It's ridiculous that the genomic revolution and blockchain technology and crypto assets are all behaving exactly alike. In fact, crypto assets began to correlate highly with the NASDAQ starting at the beginning of COVID. Before that, there was no correlation at all. And so we think this is an anomaly, a massive anomaly, and that with time it will correct and the efficiencies will be introduced back into the market. And we're all about how the world is going to change, and we're looking for those exponential growth trajectories that will happen along the way. I mentioned in terms of bonds, I'll just reiterate that if you look at credit default swaps, the Fed's getting a message like it did in 2018. Watch out. The dollar has been on a run. It's up over 15% since its low last year. That is a huge move, and it's not just against emerging market currencies. They're doing worse. It's against the euro and the pound and the yen especially. I've been shocked at the yen. It's gone from 105 to the dollar to about 130 to the dollar in the span of a year. That's huge, and it's making our goods more expensive to the rest of the world. So our export growth is probably going to slow down, not only because many countries are in recession, but also because our prices have gone up so much to them, given their currency declines. And as I mentioned, crypto, new asset class, should not look like the NASDAQ, but it does. It's highly correlated right now. You know you're in a bear market and maybe close to the end when everything starts acting alike, and we're seeing the capitulation of one market after the other. I think the Fed's going to get the message.